Frank and Georgia have the same house, the same 3 bedrooms, the same mortgage paid off, and the same fear in their minds. They watch the local news and see the segment about nursing home costs. Both turned 62 this year. Both have approximately $650,000 in assets and a pension that will cover their basic living expenses. Frank bought a long-term care policy with a $6,000 benefit, a 90-day elimination period, and a 3% inflation rider. Georgia decided she would self-insure, keeping $300,000 in reserve, relying on Medicaid if costs exceeded that amount. At age 78, Frank used his policy for 3 years after a stroke. He collected $216,000 in benefits. His out-of-pocket costs were $12,000 in premiums, plus $27,000 the policy did not cover, like companion care. Total financial exposure, $39,000. Georgia had a stroke at 78 as well. Her care costs were $8,500 per month for assisted living. Her $300,000 reserve covered 35 months. At month 36, she applied for Medicaid and began the process, which in her state takes approximately 4 months. The answer to who made the better decision depends on month 40, and nobody knows that answer except the actuaries at the insurance company. Chapter 1. You think long-term care is something that happens to other people. You have seen the statistics. The U.S. Department of Health and Human Services reports the numbers. A 65-year-old has a 70% probability of needing care. 7 out of 10. You read that number, you nod, you move on. The number is too large to absorb. It does not feel like a personal probability. It feels like weather happening to someone else, like a hurricane prediction that feels abstract until the roof is gone. Here is what long-term care actually means. It means you are unable to perform 2 of the 6 daily activities. Those are bathing, dressing, toileting, transferring, eating, and continence. It also means cognitive impairment severe enough to require supervision, which includes Alzheimer's disease and other forms of dementia. These are not dramatic medical events. They are the gradual erosion of capacity that happens after 80. You do not plan for this in your 60s because it feels abstract. You feel fine, your friends feel fine, your doctor says you are healthy. The statistics about 70% are not about you until they are. The average cost of a private room in a nursing home in the United States in 2024 is $116,800 per year. This is according to the Genworth Cost of Care Survey, which has tracked these costs annually since 2004. In some states, that number exceeds $150,000. In Alaska, it exceeds $380,000, but in Louisiana, it is approximately $63,000. The range is enormous, and it depends entirely on where you live. The average length of a nursing home stay is 2.3 years. For people who need memory care, the average length of stay is 2.5 to 3 years. For people who need both nursing care and cognitive support, the average stay extends to 4 to 5 years. These are not catastrophic, one-time medical expenses. These are ongoing, compounding costs that can deplete a lifetime of savings in 3 to 5 years. Medicaid, which is the default fallback for people who run out of money, has strict income and asset limits that vary by state. Most middle-class retirees are not eligible for Medicaid until they have spent down nearly all of their savings. That is the self-insurance trap. You think you are protecting your assets. You are actually preserving them until a certain point, and then you are giving them to the nursing home. Chapter 2. Let us take apart what actually happened to Frank and Georgia's financial picture over the 3 years following Frank's stroke. The comparison that matters is not the premium versus the reserve. It is what each person experienced and what it cost them. Frank bought his long-term care policy at age 62. His annual premium was $3,200 for a $6,000 per month benefit with a 3% compound inflation rider. The inflation rider means that his $6,000 per month benefit grows by 3% every year. At age 78, when he needed care, his monthly benefit was not $6,000. It was $8,847 per month, because the 3% compound growth over 16 years had increased his benefit by 47%. He paid $1,200 in premiums over 16 years. He collected $212,328 in benefits over 24 months of care. His net financial position from the policy was a gain of $161,128. Before accounting for the $27,000 in costs the policy did not cover, bringing his net gain to approximately $134,128. His wife Barbara was able to keep him at home for the first 6 months because the policy paid for a home health aide. The home health aide came 3 times a week for 4 hours at a time. Barbara kept her part-time job. She did not have to quit. She did not have to choose between her husband's care and her financial security. That is not in the math, but it should be. Georgia's self-insurance strategy looked reasonable on paper. She set aside $300,000 specifically for long-term care costs. She kept it in a conservative portfolio, earning approximately 4% annually. At age 78, her care costs of $8,500 per month consumed $102,000 per year. Her portfolio generated approximately $12,000 per year in investment income. That left a net draw of $90,000 per year from principal. Her $300,000 lasted 35 months, exactly as calculated. At month 36, she applied for Medicaid. Her house, which was worth $380,000, was counted as an asset. In most states, Medicaid has a look-back period of 5 years. She could not transfer the house to her children without triggering a penalty period. Her children were told the house might need to be sold to cover her care costs. Georgia had wanted to leave the house to her daughter. The Medicaid estate recovery process meant that the house could be claimed by the state after her death. Frank's house was never at risk. His policy paid for his care directly to the facility. His savings remained intact, and his wife Barbara continued to live in the house without financial anxiety. Georgia's children spent the last 2 years of their mother's life managing Medicaid paperwork. They were negotiating with care facilities, arguing about whether the house should be sold, and watching their inheritance disappear. This is the part of self-insurance that the spreadsheet does not capture. The administrative burden, the emotional cost, and the family conflict that Medicaid planning creates. It falls on people who are already dealing with the stress of a parent's declining health. The American Bar Association's 2024 survey of estate litigation found that family conflict in long-term care planning is the single largest driver of legal costs. In probate, it exceeds the complexity of the estate itself. Chapter 3. There is a version of the long-term care argument that is complicated. It is a version that insurance companies do not advertise and self-insurance advocates do not acknowledge. That version involves the people who buy long-term care insurance and never use it. It involves the emotional mathematics of paying for something you hope you never need. Approximately 45% of people who buy long-term care insurance policies will never file a claim. According to the 2024 industry data, they pay premiums for decades and die of something quick, like a heart attack, before they ever actually need the care. For these people, the long-term care insurance was financially a loss. They spent money on a product they never used. Frank would have been one of these people if he died at 75 from a sudden cardiac event. He would have paid $41,600 in premiums for a policy he never used. The insurance companies count on this. That is exactly how they price the product. The people who use it are subsidized by the people who do not. That is how insurance works, but for the individual, it does not feel like subsidizing. It feels like wasting, like paying for car insurance for 40 years and never filing a claim. You know it is the right decision, but it still feels like wasting. Here is the complication that makes this even harder. Hybrid life and long-term care policies. These are life insurance policies that include a long-term care benefit rider. If you use the benefit, your death benefit is reduced by the amount you used. If you do not use the benefit, your heirs receive the full death benefit. These products solve the paying for something you never use problem. They make the premium expenditure into an investment with a guaranteed floor. Several major insurers, including Nationwide, Lincoln Financial, and Pacific Life, offer these products. A 62-year old in good health can obtain a policy with a $500,000 death benefit with a 4% rider, which provides $24,000 per year in benefits. That costs approximately $4,800 per year in premiums. At the end of a 20-year period, if no benefits are used, the policy has a cash value. Frank could have bought this policy, but he chose the traditional one because the premium was lower. His decision was reasonable, but the hybrid product would have been better for a larger estate. Chapter 4. The decision about long-term care is not just a single decision. It is a sequence of decisions that interact in ways that are difficult to model. And the most important of those decisions happens at a specific time window, a window that most people do not even know exists. The first decision is whether you can afford the premiums. If the premium for meaningful coverage is more than 2 to 3% of your annual income, the policy may create financial stress that outweighs its benefit. Frank's premium of $3,200 per year represented 1.2% of his $52,000 retirement income, which was affordable. The second decision is your health status at the time you apply for coverage. Long-term care underwriting considers your health history, family history, and your current medications. People with significant health conditions may be denied coverage or charged significantly higher premiums. The best time to apply is when you do not think you need it, which is between ages 55 and 65. The window closes for many people around age 70. When health conditions make the product unaffordable or unavailable. Frank applied at 62, but Georgia decided she would self-insure at the same age. By age 68, Georgia had developed type 2 diabetes. If she had tried to apply at 68, she would have been charged higher premiums or denied. The window for buying long-term care insurance does not stay open forever because it closes when your health changes. The third decision is the benefit structure of the policy. The most important rider is the inflation protection rider. A $6,000 monthly benefit purchased at 62 will be worth $4,300 in 20 years at a 2% inflation rate. At 3% inflation, that benefit is worth only $3,700 in today's dollars. That amount may not cover the actual cost of care 20 years from now. An inflation rider of 3% keeps your purchasing power closer to your original benefit. Without the rider, you are buying protection that erodes every single year. The premium difference between a policy with and without an inflation rider is roughly 30 to 40%. That 30 to 40% increase is one of the best investments you will ever make. Frank's 3% rider cost him $900 per year, more than the base policy. Over 16 years, that $900 difference totals $14,400. It generated $54,000 in additional benefits when he finally used the policy. That is a return of approximately 275% on the additional premium cost. Chapter 5. Georgia did not make a stupid decision. She made a decision that was reasonable based on the information she had, the information she trusted, and the information she wished were true. She wished that long-term care was something she could handle with savings and discipline. She could not. She handled it with Medicaid and the help of her children, and the help of her children cost them time, money, and emotional energy that they will not get back. Her house may be sold to cover Medicaid estate recovery. Her daughter's inheritance, which Georgia had promised her verbally at Thanksgiving dinners for 20 years, is gone. Frank did not make a perfect decision. He paid premiums for 16 years for a product he hoped he would never use. He used it. The math worked out in his favor by approximately $134,000 relative to Georgia's self-insurance outcome. But the number that matters is not the $134,000. The number that matters is the moment when Frank's care coordinator told Barbara, that the policy would cover the facility. Barbara cried in the hallway, not because she was sad, but because one of the worst things that can happen to a family did not also have to be a financial catastrophe. That moment does not appear on any spreadsheet. It does not appear on any retirement planning software. It is the moment when insurance, the thing people resent paying for, actually does what it is supposed to do. It buys you the freedom to be a family member instead of a financial manager. There is one more scenario worth examining. Frank's long-term care policy also covered home health care, which is the care option most retirees prefer, but least plan for. The majority of long-term care in the United States is provided at home, not in nursing facilities. According to the U.S. Department of Health and Human Services, approximately 65% of Americans who need long-term care receive it at home, in the community, or in an assisted living facility. Only 35% receive care in a nursing home. Yet most long-term care insurance policies are priced around the nursing home benefit, and the home care benefit is often an afterthought in policy selection. Frank's policy paid for a home health aide at $28 per hour for up to 30 hours per week. He used this benefit for 6 months before transitioning to assisted living. The home health aide benefit cost the insurance company $13,440 over 6 months. It allowed Barbara to keep her job. It allowed Frank to stay home. It cost the insurance company $13,440. It cost Barbara her peace of mind and her job security for $0. Frank paid $3,200 per year for that freedom. It was worth more than the math suggested. The American Association for Long-Term Care Insurance, S2024 member survey, found that 87% of people who used their long-term care policy rated the experience as having significantly reduced financial stress for their family. 87%. That number is not in the premium comparison. It should be.